And let's get you one more important view. Ben Powell is Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute. Ben, good to have you with us here on the program as always. Good morning, Prashant this side. I was just talking about the FII positioning, which now I think should be, if not at a 10, at least at a 10, I think at a 15-year low in India. Just if you look at India's weight in MSCI, sort of FI ownership compared to India's weight in MSCI should be, I think, between 15 and 16%. We'll get the numbers as we go along. But what is your sense? A bit overdone here, and what will trigger a reversal in those flows?
Hi, Prashant. Great to be with you. Yeah, look, we at BlackRock, the world's largest investor, we're still pretty constructive India, but in the short term, I think it's fair to say there are a couple of headwinds. Domestically, concerns about valuation and some mild growth concerns, which are obviously very important. But I think in the bigger picture, there are a couple of major issues beyond the power for anyone in India to control, namely President Trump and China. On the China side, there's still a degree of enthusiasm, I think, an expectation and a hope that Chinese authorities are going to do more, and that can be encouraging for equities. So from an emerging market kind of exposure perspective, China is still a little bit in favor, I think, and perhaps some of that's being funded from India. But for all emerging markets, maybe all global markets, we're all looking at President Trump, I guess, right? So every meeting I go to all over the world, the first question is, President Trump, what do you think? And we are only 2 weeks away from being able to give some more concrete answers to that. So inauguration January the 20th, and then at that stage, we'll go from all kind of thinking about what he might do to seeing what he actually is going to do. And even if some of that is, let's say, challenging vis-a-vis trade restrictions and so forth, it's well understood that markets much prefer certainty. So even if the news is ostensibly bad, I think the certainty is something that we all need as global investors, particularly in emerging markets. And that would be true here in India as well, I think.
Right. Ben, we were discussing exactly this last afternoon here in India with one of the currency strategists at Barclays. And I think we were in all agreement that as much as markets would like absolute clarity on the 20th of January, that may not entirely happen, right? We need to see how these policies play out and what orders and what announcements come on a daily basis. So while that, that remains a moving piece, and we'll deal with it as the clarity emerges, what about the more India-specific issues? I mean, how real do you think they are, this whole growth concern? Is that really becoming a big sore point now? Because in the middle of 2024, the argument was that China is a tactical trade while the world awaits a rebound in the economy, whereas India should be a long-term, constructive, sort of positive view. But the money simply hasn't been coming in. The money's just been moving out.
That's true. So how real is the growth kind of scare? I think it's a little bit real. So I think probably the risk to earnings is more to the downside than the upside. So, that's not good, I suppose. So there is a little bit of a genuine negative. But I think, we've all been in markets for a long time. You do have kind of a strange reality whereby price leads sentiment. So what does that mean? It means people tend to be bullish when markets have gone up, and they tend to become more bearish when markets are going down. That's just human nature. It might not be rational. Theoretically, we should buy low and sell high, but it feels so much more natural to kind of do the opposite. So I feel like selling low is where we are. That's likely to persist for a period of time. Selling makes people nervous, and that begets more selling. And it feels like we're not fully through that issue. So for me, we at BlackRock are fully kind of on board with the medium-term bull story for sure. In the short term, there is a growth concern. I don't want to totally dismiss that. It's there. But I think actually it's more of a kind of technical unwind of positioning, which it still seems like has further to go, at least for now.
Good morning, Ben, and good to speak to you as always. This is Nigel on this side. I recall the last time we chatted, our audience along with you, we were hoping that maybe the FI outflow could be hitting a peak. Well, hopefully that time has come, and hopefully we'll see that rather soon. But let's talk about central bank action. What are you factoring in with regard to central bank action for 2025? From the Fed, they're hinting at around 2 cuts. The street is hoping for more. That's the equity markets. And also with regard to what the Bank of Japan will do. Because yesterday there was this fear that the yen carry trade unwind could be hurting equity markets. And part of that could be India as well. So what are you factoring in from both these two central banks?
Yeah, for the Fed, we've had for years, actually 2 or 3 years, we've had a strong view that inflation is going to continue to be a problem driven by very significant structural changes to the supply side of the global economy. And what that would mean is the Fed wouldn't be able to cut as much as many were hoping. If I may say so, that view's been approximately completely correct, and we still hold it. So we think the Fed will have probably room to cut a couple more times to 4%, but probably not more than that. So one question we get a lot is how can we be relatively hawkish and yet still bullish? We are still bullish US equities, by the way, and that's because of the growth and earnings powering ahead, in particular from that AI tech space, which we think is going to continue. So to summarize kind of all of our work, we continue to be relatively hawkish vis-a-vis the US, and yet we are still quite bullish because we think the earnings trajectory is likely to remain very robust, particularly in that AI space, which for us continues to be a mega force. On the Japan side, they're going to move very carefully. Right? The Bank of Japan is extremely aware they are in an extremely delicate position, but it seems to us now they should continue the slow policy normalization. So the next Bank of Japan meeting is January the 24th. Just a couple of weeks away, and our expectation is they will push through a hike because economic conditions deserve that. So they have a much different inflation backdrop than for most of the last 20 or 30 years, meaning inflation seems to be much higher and also much more entrenched, much more sticky. So the Bank of Japan will move, but we think they are extremely mindful of the risks, and therefore we think it is unlikely they will kind of ruin the whole party, both for domestic Japanese equities and globally. So Fed cutting a little bit and BOJ hiking a little bit, both of them crossing the river by feeling the stones. Let's see how we go, but optimistic the Bank of Japan will do so, will hike in a very, very careful and considered manner.
Yeah, absolutely. They've been fairly restrained given the inflation prints in Japan, which remain quite elevated. Ben, finally, sort of wrap it up. I mean, it's very clear that you folks still like US equities. You're still believers in the AI story. Outside the US, where else would you put money? If not India, then where else? And I'm talking, short term, say the next 1 or 2 quarters of this calendar year.
Yeah, so we are overweight Japan. A lot's going on in Japan, but I think I can summarize it into 2 main points. Firstly, the nominal GDP outlook in Japan is totally transformed from where we've been over the last few decades, meaning much better. So nominal GDP is something like revenue growth for the overall economy, and that's gone from catastrophic to pretty good. So Japan's nominal GDP outlook is revolutionized in a much more favorable direction. That would be one thing. Secondly, in Japan, you also have a corporate governance reform story, which I think is going to continue. There's been some political kind of ups and downs, but the corporate reform story is ongoing and untouched. So that combination of nominal GDP, pretty good, multiplied by corporate governance improvement, we think is Japan up. So to give you one, we would cherry pick Japan as a place we like tactically over the next 6 to 12 months.
All right, Ben, it's a pleasure. Thank you very much for joining us and running us through, all of those sort of aspects. And it's a complicated puzzle, global markets, but they always are. And sometimes they seem a little more complicated than usual. And I think now is one of those times. Thank you once again for being here.